Well, hello, hello. How are you doing today? Hopefully, you're well and you had a great weekend. Hey, it's your resident online mortgage lender, Robert Lewis, NMLS license number 180100, with today's market update. Someone asked, hey, why is it that you're doing the market update around noonish? And that's an excellent question. And it's because I want to give the market ample time to respond to any of the economic data that comes out that really has an effect on the 10-year treasury, which we'll go over here in just a second, so that I can give you a better feel midday, as far as the central time zone is concerned, about where rates are currently uh, at, if you will. And two other type disclaimers, if you will. Anytime we're talking about rates, remember it's not your specific rate. We're just giving a range, if you will, of where rates are at this point in time. Obviously, if you're watching on the replay, that's going to be different. Said all that to say, you would need to qualify with whatever lender that is that you know, like, and trust, and get an accurate picture based upon where you stand. Lastly, per the friendly reminder on the screen, this is an interactive uh, broadcast, if you will. So if you have a question, be it live or afterwards, if you're watching VOD, video on demand, put a preceding cue in front of the question, just like the friendly reminder says, because if not, you're just making a comment or statement, if you will. So all questions are welcome. Okay. So today's agenda, as you can see there on your screen, the economic report that's coming out today. It's a little later today, a couple of hours here, 3 o'clock CST, but I believe it's a canary in the coal mine, if you will, a leading indicator as to where the economy is going. And why that's important for those of you that are watching me is because you're either waiting to buy, refinance, you know, and you're wanting to get an idea of where the rates are going, what the interest rate environment is, where we are currently as of the 8th of January 2024. So the consumer credit data leading indicator, right? We'll go over the 10-year treasury, talk about HELOCs, HELOANs, second mortgages, things of that nature, if you shouldn't. So HELOCs, cash outs, and then as we wrap up, we're always going to talk about the down payment assistance program. At any time, if you'd like to get on our calendar, take out your phone, hit the QR code, or avail yourself to the link, type it in the browser, and let's have a conversation. So without further ado, our first topic, the consumer credit, we want to look at the following chart. Let's go over here. Bop, bop. So, as I stated, today, 3 p.m., consumer credit report. Very, very important, right? It's going to give us a lot of information as it pertains to how people are tapping into either equity in their properties or utilizing credit cards. Those are the two main metrics that I look at. Why? Why is that important? Yeah, well, it tells a lot. A lot of the stimulus money that was issued out to a lot of folks over the last couple of years is drying up, right? Folks are going to start tapping in to different types of reserves, which would lead me to believe that there's less money circulating around, i.e., less competition for the goods. The good that we're speaking of in this context is residential real estate, right? 1, 2, 3, or 4 units. So there should be somewhat of a correction. As I've stated, guys, if you're on the sideline, real estate is local. You have to understand your local market, okay? And then it would not be a very wise decision, in my opinion, based on data, for you to be looking for 2019 prices. Just not going to happen. There's a correction. Even if it's a 20% off of the highs, year over year, home prices in all but 3 or 4 areas that I've found are still up. Okay. So you have to come to terms with a higher purchase price. Now, if you get into the market or not, obviously that is a decision that you would make. But consumer credit today, right? Other than today, what I'm waiting on is on Thursday. Thursday is going to be a big day, right? Initial jobless claims and the CPI data, right? This is going to really tell us if the trend is really our friend and inflation is going down the way it should be. And then at some point in time during this year, we should start seeing some Fed funds rate cuts, as Chair Powell had alluded to in the last meeting, right, saying that they were going to hold off. So this is why these reports are important, if you will. But today, keep your eye on the consumer credit report, right? Now, when we jump over to the 10-year, right? Let's go back. Let's see here. Yeah, 10-year, that's next. Okay. So when we go back to the 10-year and look, this morning it was up. It's actually down on the day, but it was up over 4%. Those of you that are following, educating yourself to the extent that you need to look at a couple of things as you're going about your daily life and the things that you do daily. These are a couple of quick things that you can look at to see, hey, Robert said whenever this 10-year is trading below 4%, that's a good thing for rates. Uh, you know, let me reach out to my lender to see where I am, right? The number that we really want to see, obviously, if it gets below 3%, that's where, rates are really going to run, if you will. I think rates this year are going to be anywhere between, best case scenario, 5.5% to 6.25%, somewhere in that range. If something goes haywire and inflation starts going back up, we could jump back up into the 7.25% range. I tend to think that that's not going to be the case because of an election year, but who knows? As I told you before, everybody's guessing, okay? Doing our best to do an educated guess. So that's the range, right? Large range, 7.25%, 5.5%. Numbers show, though, the stuff that I'm tracking, anything at 5.75%, 5.75% to 5.5%, a lot of folks are going to be getting into the market. So it's very important for you to prepare yourself and not be chasing an approval and things of that nature. You want to have those things in place if you're waiting and waiting with a purpose, right? Because those monies, when they hit, folks are going to jump, all right? And there's still, regardless of what you hear, there's still a shortage of inventory. I showed that last week. Avail yourself to last week's market update, where we use Texas as a microcosm of the bigger picture, but inventory, still trailing. But if you ride around in your city, you're starting to see more single family home construction, and that's in line with the jobs report that we got on Friday. In that sector, construction sector, not as much multifamily. That's what we've been seeing over the last couple of years. And so that should help with those of you that are going to rent. And we'll see what it does with the rental costs on a monthly basis, because there's more units online. But that's what they're talking about when that housing inventory, single family inventory, more so in the multifamily space. But now I'm starting to see more single family homes, more on the new construction side, right? So again, got to make sure that you're prepared, and you want to watch the 10-year, okay, 10-year. And anytime we're in the 4, great. Closer we get to 3, even better, okay? So consumer credit, we've hit. 10-year Treasury note, hit the key things that I want you to pay attention there. Let's talk about home equity line of credits, cash out, or HELOANs or second mortgages, right? All these things that folks are talking about here lately. Okay, we're going to kit these two all in one, right? And so the way I want to do that is look at it from the mindset or from the lens of why. A lot of times on YouTube and these places that we go to, people are on the how to, because they're selling stuff. Okay. No problem with that. That's a part of the process. That's what some of the platforms are for. But we need to start getting into the why and the when. The why and the when. And then when you understand those two things, the how, that's further along that continuum, if that makes sense. So why consumer spending is important, right, is because even as of 2024, consumer spending is anywhere between 65 and 68% of the gross domestic product. Okay. So this is a consumption type of an economy. So it's very important. Okay. And this article, and it's linked in the description, it's from 2008. And this consumer credit report from the standpoint of the economic data is called the G19, right? That's the report that you're looking for. But um, it, I wanted you guys to understand what the reason for the report is and why it's so important. So as you can see here, I have highlighted why consumer credit is so important. And here's the deal. It says the availability of credit, right, supports consumer spending for large items that can't easily be bought, or that can't be bought unless if you don't have the cash, right? So things such as vehicles, furniture, appliances, large appliances, um, durable goods, okay, some large durable goods, financing for other types of consumer spending, everything from tuition to vacations, okay, is also affected by the availability and cost of credit. And we see that in the housing market, right? When the rates went up, it took a lot of people off and put them onto the sideline because they could not afford it because the cost of credit went up, right? And then it says the availability directly affects consumer spending. So that's why HELOCs, cash out home equities, and HELOANs, if you will, they've been rebranded. Just call it a second mortgage. So why someone would tap into those things? I alluded to it earlier. Okay, because you don't have the cash for larger items that we need in the economy, that people need on a day-to-day basis. I had someone reach out to me and wanted me to go in depth into a detail on when someone should consider a home equity line of credit. I'm not going to go directly and give you my opinion because that is a personal decision, and there's a lot of emotions tied to it. Let me explain. Quick example. I would never use any equity in any property that I own to take a trip, to go on vacation, but that's me. You might think that's fine to do. Okay. To each his own, such as the spice of life, right? So when people are looking to tap into the equity of their home, the reason HELOCs are very attractive and favorable to them is really the ease of getting into one of those types of products. It's not as intensive as far as documentation and things of that nature are concerned. Pretty much, if you have the debt to income ratio, if your money's not funny and your credit can get it, not a lot of costs, not a lot of fees. But the deal is this: it's a lien that's attached to the home. Number one. Number two, you have to understand the periods in which I've never seen one that's above a 10-year period. Okay, meaning at 10 years, it stops, it's locked out, and then you might have 15 to 20 years to pay it off, whatever that balance is. But more times than not, on home equity line of credits, they're interest only, okay? And they can affect your credit score because it's a credit card, right? So as an example, say you have a $50,000 line of credit, you put a $50,000 balance on it, well, it's gonna mess up your utilization. You may not want to do that, okay? You may want to look into a second, that's a fixed rate over a period of time, okay? And it's not revolving. And then to further make it a little more complicated, in the home state in Texas, we have laws put in place to protect us from ourselves to where we can never leverage more than 80% of the value of our home. Moreover, for HELOCs, you have to do so on your primary residence only because of the homestead laws, right? You can get a cash out loan, a second, or a cash out on a rental property or investment property, something of that nature, but you can't do a HELOC in Texas, right? But I digress. Point I'm trying to make is the why. You don't have the money and you need a large chunk of money for renovations. A lot of people do pools. Okay. Some people take vacations. A lot of folks look at HELOCs for investment purposes, maybe a flip or to take down a property that you're going to rehab and things of that nature. Myriad of things that you can do with the HELOCs, but those are the things that you have to understand. It's an adjustable rate mortgage, right? Tied to the Fed funds rate. Let's see here. What is the Fed funds rate for today? It's tied to the Fed, but from the prime, okay? So the prime rate today is 8.5%. And depending on what lender you're dealing with, they're going to add their VIG on top, their margin on top. But what you have to realize with these HELOCs, folks, banks, folks like us, we know and understand human behavior. And so you really have to watch yourself. And what I would say to you is this: if you're not someone that's been paying off or is accustomed to paying off all your balances on a monthly basis before you're paid or before you are charged any interest, and then you think, hey, I'm going to get this HELOC and do some type of mortgage payoff strategy. I had a video about that. I ran it. I won't go to YouTube. You'll check it out. You probably don't want to do it because you're not in the position and you don't have the behavior of doing so. Moreover, since I mentioned that strategy, the HELOC to pay off the mortgage in 5 to 7 years, what these folks don't tell you is this: you need an influx of income coming in on a regular basis. Well, think about it. If you had large cash flows coming in on a regular basis, why do you need to go get another debt instrument that's volatile and unsure to accelerate the payoff on your mortgage? I showed in the video where you can pay off your mortgage in 2 years. The issue is the reason that strategy attracts a lot of people is because you don't have the income coming in. So again, think about those things when you look at these types of products. Not saying not to use your equity. That's the benefit of having it, right? But you have to know and understand who you are and what your behaviors are. And ultimately, if it sounds too good to be true, it is, right? So HELOCs, prime rate, you can pull it up. Whatever lender you're dealing with is going to add their VIG on top of it, right? Why folks do HELOCs, cash out home equities, HELOANs? Because they need a large chunk sum of money for whatever reason. Okay. And that is the why. Okay. Now when you should do it, again, do you have the ability to pay this money back? Because regardless of how they market you tapping into the equity, it's a lien against the home. And if you don't pay it back, you can lose your home ultimately. Okay. So the win is when you can afford it. Afford what? The monthly payments, the managing of it. In other words, have a plan of action to get yourself out of that debt. It's like me talking to a lot of clients that I have, and they're asphyxiated on a credit score or business credit and things of that nature. It's debt. It has to be paid back. So anytime you leverage, in my opinion, are you getting appreciation? Okay. Are you getting cash flows? Even better. But if you're not getting cash flows, is there some type of tax depreciation advantage that you can take advantage of when you leverage these funds? In my mind, that's when you leverage. If not, all of these sexy marketing terms is just a way for you to get comfortable with being in debt. And ultimately, the book that I subscribe to, the Bible says the lender is the king. Or in other words, it says the borrower is servant to the lender. Keep that in mind as you guys move forward, okay? So I think that hit it. HELOC, HELOAN, second mortgage, cash out, when you should do it, when you can afford it, when you have the equity, how you should do it. That's something that you and the lender that you know, like, and trust can strategize on and define the best path for you and the goals that you're trying to obtain, okay? So let's see here. Where are we at? Yeah, we did the HELOC. We did the cash out. What's next? Let's talk about our DPA programs, and then we're going to let you guys out of here, right? So as I told you, we're going to speak from a Texas-centric down payment assistance strategy, but we also have some nationwide strategies. Keep in mind, we live nationwide. but I speak Texas because that's the majority of the down payment assistance that we're going to do, right? So starting it off, TSHAC, Texas State Affordable Housing Corporation. There's a grant version, as you can see here. There is a deferred second, forgivable second, 36 months. Compare that to Louisiana or some other states, Mississippi. I think Louisiana has got to be there for 5 years before it's forgiven. Might be 10 years in Mississippi, right? So you just have to know and understand what state you're in and what the forgivable periods are on these down payment assistance. But they generally come in three flavors, right? It's either going to be a grant, a forgivable second, or a repayable second. And then my favorite with the down payment assistance at this point, in Texas, unfortunately, neither one, TSHAC nor TDHCA, the one I'm going to show you next, has the mortgage credit certificate at this time. So again, it just goes to show you, things don't stay around for always. You have to take advantage when time is there. But as you can see, those are the rates for the day. TDHCA, okay? Like these programs as well. Why? Because they have more flexibility in that you're going to pay them back. Okay, that opens up the door for larger incomes and things of that nature. Yeah, good program as well. Just have to see if it's a fit for you and what you're trying to do. Okay, when people ask, hey, what program is the best? What's the best one for you? Well, how do I know? We can't talk about it over the phone. You have to apply. You have to submit all your documentation, and you got to have a conversation to figure out what it is that you are trying to accomplish, right? For my veterans, Texas Vet, Texas VLB, okay? If you meet the discounted requirements, to this week's rate is at 5.68%. If you want to do this, again, rates come out every Monday. You need to really make the decision if this is the rate that you want so that we can secure the funds, because there's a process, okay? Don't wait till the last minute. And that really needs to be done by Thursday. That's worst case. I like to say Wednesday, 2 o'clock. Thursday, 2 o'clock, you're pushing it. So you need to secure your funds by Wednesday, 2 p.m. to assure that you're going to get this week's rate. And it comes out every week. I show you the rate every week. And then for our nationwide folks, okay, conventional flavor, all the ones that I mentioned before, they do have a conventional component, but generally they're government insured, FHA, VA, USDA. This is a conventional option that is going to be available nationwide, including Texas. And the One Plus, bottom line, 2% grant back to you. Here's the key: $350,000 or less on the purchase price. Okay, let's just look. Let's read down. You know what? I got to update that because there is currently in the new year, you do have to pay private mortgage insurance, but it's at a very discounted rate. But all of last year, you didn't have any private mortgage insurance to pay. Okay. Let's see here. Available to everyone that's at or beneath 80% of the area median income. And that's going to buy $350,000 or less. Okay. Let's see here. Boom, 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 boom. If you're using a manufactured home, you got you got to put 5% down. Okay. So in essence, you're going to be getting in with 3% down payment plus closing costs, 2% will be given back to you. Okay. That's the key things here, right? On the purchase plus, the difference is you have to be living in one of the qualified census tracts, and they really open it up. Texas has a lot of places now in those qualified census tracts. If you're living in the census tract at the time of application, you could buy anywhere in the country. Beautiful, right? Conforming loan limit, $766,250. I mean, if you qualify and you can afford it, then you could get it. And you can get up to $5,250 back, or not back, but towards either your down payment and or closing costs. So there you have it, guys. We hit the lick on the stick. I'm getting better. If you like the presentation, let me know. I want to bring a better product. And as I go, that's the thing, especially for those of you out there that might be feeling a little discouraged, have some dismay. You think life is going to be daunting because you couldn't or didn't buy a house in 1970. Well, we couldn't buy a house in 1970. We weren't of age. A lot of us weren't here. Okay. So here's the deal. It's about increasing your value to the marketplace. Because regardless of what folks are telling you, you have to earn more. We're in the 21st century. Things have changed, right? As you see, me before you here today, I'm constantly working on even getting better to provide more value. So again, if you like the presentation and things of that nature, and if the information is valuable, that's the key. This is not an entertainment show. We're here to help people that are serious about becoming homeowners, move up owners, or even investors as it pertains to residential real estate. So let me know. Helps me out. I thank you in advance. And as always, if we could be of an assistance, reach out. You guys have a great day. And probably won't talk to you on the market update until Thursday when those CPI numbers come out. But if something happens during the week that I think is pertinent, I'll let you know. Talk to you guys soon. Peace.